Alright, welcome back everyone. In today's video we will be looking at Tesla's Q2 earnings results. For those of you that are in the loop, you know that it was not the prettiest earnings, and Tesla bulls have kind of reserved themselves to kind of ignoring quarterly results for now. It's all about the future, and we will get into some of that in today's video, but mainly I wanted to take a look at some of the financials. So I've prepared a lot of charts, as always with these kind of videos. When I do the reviews, there's a lot of charts, a lot of visuals. If you're just listening along and not watching, I will try to tell the numbers out loud if you're on the go, like podcast style. But first, of course, let's get right into it. We have the revenues, and I've broken it down into segments. Overall revenues are down 11.8% year over year, with the biggest decline being in automotive sales, 16.4% decline, and auto leasing also down 5%. And energy generation, which I was quite optimistic about going into the quarter and into the future, with all the new expansions necessary for infrastructure and stuff like that, down 7.3%. The only consistent grower really the past couple of years, and at quite a fast pace actually, is services and others, up 16.8%, so basically 17. And as I mentioned, overall revenues down basically 12%. And there's an interesting composition here. It's kind of changed compared to a year ago, which really tells you how Tesla is evolving as a company. I mean, even in the investor presentation that they released, they're like, yeah, we are transitioning the company into something more than what we are today. Hinting at basically typing out that we're going to be an AI company, an autonomy company, a robotics company. We're not seeing much of that yet. I do have some charts relating to AI we will get into, but the composition of the revenues as of right now is automotive plus auto leasing, 74%. A year ago, that was 80%. So, autos declining 6% in the overall revenue mix year over year. Services make up 13.5%, and that was only 10% a year ago. So as I mentioned, services are really growing. Energy is currently 12.4%, and it was only 7.7%, so almost a double year over year. So, energy is growing overall very fast compared to the other revenues, the fastest actually, but yeah, not the prettiest quarter. And we will get into, what the segmented stuff. So first, when you're talking about Tesla, you always have to talk about car delivery. So I've broken out, Model 3 and Y, which is the biggest segment for quite many years now, since the launch basically. And then we have Model S, X, and Cybertruck. And this is the year-over-year delivery growth. And if we look at the S, X, and the Cybertruck, it is down 52% year-over-year. So those models are not really attractive at all. If we look at 3 and Y, also down 12%. And of note is that even the prior quarter, it was also down 12% year over year. So, we haven't really seen an increase since Q3 of 2024. And that was, almost a year ago now. It's just been a steady decline since then. So if we instead have a look at the actual units instead of just, the breakdown in percentages year over year, Tesla delivered 384,000 vehicles in the quarter. It is up from the quarter prior, which was 336,000. 337 if you, round it upwards. It is not looking pretty at all. A far cry from that, 2 million per year run rate that a lot of people had envisioned for 2025 going into the year. As we can see, Q4 numbers was an all-time high, almost reaching that 500K mark. But since then, it is not looking pretty. And, given the regulatory changes, which we will also get into in just a moment, I'm not seeing how this will turn a lot more attractive in the near term. And by the earnings call, it doesn't seem like the management is expecting that either. They're expecting quite a few tough quarters ahead, but always keeping the vision towards the future with robotics, autonomy, FSD, But the way I see it is you really need to keep expanding the fleet at quite a big pace. Because that supports the whole idea of autonomy. It increases the network once you go, robo-taxi and people can use their vehicles. So it is necessary for that. It is necessary for training. It is necessary for monetizing FSD. So it really is a big deal that deliveries are, struggling. It is very important for Tesla to actually manage to scale the fleet much faster, because the numbers that we're seeing now, Tesla's basically been stuck in a loop for 3 years. Not loop, what's called? They have been stagnant for 3 years basically, because these numbers are numbers we saw in 2022. And if you asked a Tesla bull or Tesla investor in 2022 what kind of deliveries they're expecting in 2025, it wouldn't have been the same that they are reporting right now. It would have been a lot higher, probably. So not very pretty. Another interesting thing here is that for the first quarter, also in 3 years, exactly, we are, meaningfully increasing the price per delivery. And this is interesting because there's been talks of, because Tesla is becoming so much more efficient in manufacturing, that they are able to lower the pricing of the cars. And also when you're talking about, releasing a cheaper model, which they mentioned that they are, starting early builds of as of June, and they expect, volume scaling for the second half of this year, which is, right now. So when they give a timeline that is right now, they seem pretty confident, but you never know with timelines with Tesla, which is another thing. But for 2 quarters in a row now, the price per delivery, averaged out, is actually increasing, which is quite an interesting dynamic, because for a long time now it has just been going down, which makes Teslas more affordable. More people can buy them. More people can use it for training, FSD. It supports that whole core thesis about autonomy as a whole, when Teslas are more affordable. But now, with EV credits going away, this is probably gonna keep increasing for a while. We'll see what happens with the more affordable vehicle, but it's still an interesting dynamic to have a look at. So for those just listening along, the implied price per delivery for this quarter is 41.8 thousand. Sorry, the quarter prior it was 40,000, and prior to that it was 39.8 thousand per delivery. So up above that 40k line for the past 2 quarters. Another concerning thing here is looking at the global inventories. So this chart details the days of supply that they report in their earnings. And, Q4 looked pretty good. We had a scare when it went up, spiked to 28 days of supply in Q1. Then, offloaded vehicles started to have, campaigns, incentives and stuff like that. So it went down to 12 in Q4. However, now we're all the way back up to 24 days of supply, up from 12. So basically in 2 quarters, we have doubled the days of supply. And 24, if you look historically here, I've charted out since 2018, the demand is not very high. Like the inventory here is very, very high. So that's not really what you want to see as a Tesla investor. It will be hard to have, only 3 to 4 days, when used Teslas used to cost more than retail Teslas, just because you had to wait so long. These like 3 days of supply kind of days back in late 2021, early 2022. But still, 24, very much heading towards those, historical highs, which is a bit concerning that they are not able to offload what they already have produced. Which is more evident in this chart, which is, the solid line is total deliveries as a percentage of production. And with that one, you can notice that it is often above 100%. So they deliver more than they produce. That means that they are, offloading inventory. And historically, it has pretty much stayed close to 100, with a few dips, towards that 95% range. But now, we're heading down towards that 90% instead, which means they are producing a lot and not really delivering, which translates into these days of supply, when you look at the overall inventories. And if we look at capacity utilization, which also goes hand in hand, it is one thing if you can't deliver everything you produce, but you're producing at max capacity. Tesla is only producing at 70% capacity, which makes this 94% here a lot worse than the 92% here, where Tesla produced at 93% capacity. So, you have to look at these two together. If they are producing at a very low capacity and they're still not being able to deliver what they produce, that is kind of concerning. Teslas are just not very attractive right now, is what this tells me. This capacity utilization, it could be explained, they are refreshing models. They are making way for new models. Cybertruck is still being worked on. Semi is still being worked on. Maybe counted towards that capacity. Stuff like that. There could be reasons, but, just on the numbers here, if you're looking at it like this 94% at 70% capacity, concerning. Prior quarter was worse though. 93% total deliveries as a percentage of production. But the production capacity used was only 62%, so almost like half. That quarter was very, very scary. So a bit of a recovery, but not looking very, very good. And another thing here is that I've charted up the automotive regulatory credits revenue. And this one is interesting because if you look a year back, this was at an all-time high at 890 million auto regulatory credits revenue. So almost $1 billion in just regulatory credits. It is now down 51% to 439. And the trend here is pretty obvious. It is, a stairway towards the bottom for each passing quarter. And with the current government and president in charge, we can probably expect this to keep decreasing and become even less meaningful. So that is also another point of concern because, they are essentially losing that as a source of revenue. And if you chart it out like automotive regulatory credits as a percentage of overall auto sales, it is now at 2.8%. It has been lower than that historically, but that's just because sales were much better. But now when auto sales are decreasing and also the regulatory credits are decreasing as a percentage of total auto sales, it also adds to the pain that Tesla is seeing. Interestingly though, Tesla was down on earnings. It was up today, 3.52%. So it's keeping that, 316 currently, keeping above 310. Pretty impressive that the bulls are stepping in. Next up, energy generation and storage sales. Now, this one, maybe there was no point to chart it back all the way to Q1 of 2018. But we saw this, huge jump during Q2 of 2024, where we went from 1.6 billion to 3 billion. So almost a double there quarter over quarter, which was so impressive. And that's when, the thesis started to change for me. I'm like, okay, something interesting is going on now. So then we had, Q3 was a bit lower, 2.3 billion, and then right back up to new all-time highs, 3 billion again. And now it is a bit lower for 2 quarters in a row again. So a bit of a decrease here year over year, but overall the trend is positive. So on a trailing 12-month basis, this is absolutely insane. But, when they're talking about how they might be impacted by tariffs and a lot of stuff like that, I don't really know how energy generation and storage sales will be affected. Is it just a near-term thing? Will it be able to re-accelerate? We started to hear about the Shanghai factory starting to ship out solutions as well. So there's a lot of stuff that needs to play out here. But yeah, definitely macro concerns for this segment. And its ability to keep growing at such a staggering rate that we saw during 2024, on a year-over-year basis. And looking at the gross profits here, weren't quite able to go above 30% gross profit margins for the energy generation and storage. But still, it's still an all-time high in overall gross profits. But the margins weren't able to cross 30% yet. But still, $846 million in energy generation gross profits. Just thought I would include that. And yeah, again, I don't know why I kept this like early stages. It doesn't really add much, but yeah, it's there for you. However, if you look at the storage deployed here, it is actually been going down for 2 quarters in a row. So on a year-over-year storage deployed growth basis, it grew 2% compared to Q2 of 2024. And of course, the 2 quarters prior had a lot of easier comparison periods. So Q1 grew 157% and Q4 2024 grew 244%. And as you can see here, just by the overall, storage deployed per quarter here, there is a bit of cyclicality. It seems, those probably Q2, Q3 should be a bit stronger. So we'll see what happens if this can rebound in Q3 of 2025, and we'll see how it goes. But yeah, a bit concerning to see the storage deployment going down for 2 quarters in a row. And here's a fun chart. So Tesla started reporting AI infrastructure in their inventory statement here. And it is not as explosive as you would imagine. So it says AI infrastructure and other. So I'm not really sure what the exact composition of this is. But when you're talking about becoming an AI company, and then you hear the hyperscale, of course, Tesla is not a hyperscaler, so it's not a fair comparison. But when they're saying, yeah, we're gonna be needing to spend like 60 billion in capex this year, or 50 billion, or whatever it may be at the hyperscalers, and then you see Tesla's overall AI infrastructure at 6 billion in Q2 of 2025, growing 14% year over year. No, quarter over quarter, sorry. So I didn't chart year over year on this one, but quarter over quarter, 14%, still a big increase and jump. But I wonder what this needs to look like for Optimus and Robotaxi to actually be able to scale and be mature. I'm not really sure what is needed here. I imagine most of this is towards FSD training. But yeah, it's not really detailed all too much in the SEC filings, but still, I thought it would be interesting to chart it up for you guys. I'm not sure if anyone else has done it. I've not seen it for anyone covering Tesla, but yeah, up to 6.2 billion. A year ago, it was 2.4. So, more than a double in a year. So we'll see where it is from a year from now. And maybe we can get some clarity on exactly what it is composed of and how it's being used and stuff like that to kind of try to make sense of the numbers, but still interesting chart to include. Now let's get into the profitability margins a bit, the profitability metrics. So here we have both free cash flow, so standard cash from operations minus capex, and then also free cash flow to the firm margins, which is after reinvestment. And after reinvestment, Tesla has been free cash flow negative for 2 quarters in a row now, which it hasn't really been since Q1 of 2023, where it was negative 1%. We had this outlier in Q1 of 2024, but besides that, Tesla has managed to stay free cash flow to the firm positive for many years now, but 2 quarters in a row now where it is negative after looking at reinvestment. So the changes in net working capital included instead of just looking at cash from operations minus capex, which also is dangerously low to going negative at 1% for the quarter, down from 3%, which is down from 8%, which is down from 11%. So a steady decline for 4 quarters in a row here, or 3 quarters in a row, sorry. And not very pretty in terms of the free cash flows, but kind of makes sense when you are, expanding a bunch of segments globally and investing a lot in capex. So it kind of makes sense, that Tesla goes through these cycles where they can increase their free cash flow margins, and then they are building a new gigafactory, and then free cash flow margins are taking a hit. So stuff like that happens with Tesla, but still a bit concerning to see it in the negative for 2 quarters in a row after all the reinvestment needs into the business. So that's a bit of a concern for me personally, because if you guys know intrinsic valuation, typically when you do an unlevered discounted cash flow model, you would use free cash flow to the firm that also looks at all the reinvestment needs. So when that is negative, it will affect a lot of valuation models if this keeps it up. And then in absolute numbers, the free cash flow to the firm in terms of millions was down $1 billion, and the quarter prior it was down $369 million. So those are the actual numbers that translate to -2% and -5% margins there. And in terms of the free cash flow, X went kind of crazy on this when everyone started posting about a decline of 89% in free cash flow growth year over year, which of course is not good. But when you look at the actual number here, it is also a bit not good. So 146 million in free cash flow, down from 664. So even quarter over quarter is like a brutal decline, which of course in Q4 they did 2 billion, and in Q3 of 2024 they did 2.7 billion. So still this, for most charts, if you have noticed, there's a staircase going downwards for most financial charts of Tesla. And here we have an overall breakdown of the different margins per segment. So we have the auto gross margins, services and others gross margins, energy and generation. And what I've actually given a label here, which we can see per quarter, is the overall gross margin, which is up from the 2 quarters prior. It's now at 17.2%. And all segments actually increased in gross margins. So that is positive, of course, for Tesla investors. And you can really see that the energy generation and storage gross margins here have gone from being negative a couple of years ago to actually being the strongest gross margin segment, which it should be. Auto gross margins can't really grow all too much unless there is some crazy demand for Teslas, and they can just jack up the prices completely. But probably expected to stay here close to 15 to 20% for the autos in a good scenario. Services and others, servicing vehicles, stuff like that. It is not a high margin business. Like 5 to 10% is what you can expect there. At least they are servicing vehicles profitably on a gross margin basis since 2022 basically. So it's gonna be interesting how they start to include the new segments. So robotaxi, does that count towards automotive? Will it be its own segment? Optimus, will it be in others, or will it be robotics? I imagine it will be its own segment. But also when FSD starts to scale properly, will FSD be services or auto? The breakdown is gonna be interesting, because Tesla is one of those companies that don't give us segmented operating expenses. So we don't really know the operating margins for each segment. We just know the gross margins, which is kind of annoying when you want to value a business. You kind of want to know, exactly what the operating margins are, because that is a huge input into your valuation model. So you kind of have to do a lot of guessing with Tesla. You kind of have to look at industry averages, and then imagine that Tesla, with their sheer scale and manufacturing prowess, have an edge on the industry average and stuff like that. So that's how I approach it, at least. But yeah, it's going to be interesting when they start to introduce new segments and how the overall gross margin will change. I imagine it won't look very pretty, in the initial stages, but we'll see. The overall positive one here is, of course, energy generation and storage gross margins staying at that 29%, not quite crossing 30% yet. However, while we don't get segmented operating margins, we do have operating margins on a total. And it is, Tesla has been operationally profitable since the Q3 of 2019, consistently. They haven't dipped below into the negative since then. It was kind of close last quarter, 2% operating margins, now up to 4%. But what you really want to see as a Tesla investor is, these historical strong periods when the demand was very high, because that is essentially what people are envisioning for Tesla as a whole. The overall sentiment in my voice is probably very negative for all the charts we have seen, but keep in mind, people are expecting people are holding Tesla in very high regards, and they're expecting a lot of positive things where Tesla is gonna be a monopoly within many different segments, everything from supercharging to autonomy to robotics to robotaxi. They imagine vehicles will dominate the EV market, stuff like that. So you kind of want to see operating margins, at least above 10%. And with those monopolies, maybe even break, consistently above 20%. I don't know how, FSD software, how operationally expensive is it to scale FSD? Probably it's going to be one of the stronger segments. If we look at strong software companies, we're talking, above 20% operating margins. For the very, very strong software businesses, we're talking like 40%. So it's going to be a strong one in terms of generating operating income. Don't really know for Optimus. Every time manufacturing is involved, it gets kind of dicey and tricky. Generally, anything related to manufacturing isn't very high in terms of operating margins. So something to keep in mind and interesting. I'm just glad that we broke this 2% downtrend here we had. So one of those that started as a staircase down, but I actually improved for this quarter, which is good. Then I have some miscellaneous here. We're up to 30 minutes, so I'm gonna try to keep it short. Superchargers, growing consistently. They are now growing 14% year over year, same as last quarter. So yeah, as they grow, the overall supercharger stations, globally, it will be harder to reach, those 30% year over year or even crazier number that they've had historically. But yeah, as long as this keeps increasing and building out the infrastructure globally, very good. And hand in hand with that is, of course, the supercharger connectors, which has an interesting dynamic here. So keep in mind, the overall supercharger stations grew 14% this quarter, but supercharger connectors grew 18%. And the quarter prior, it was 17%, but the quarter prior in terms of the stations was 14%. So 2 quarters of 14% in stations, but connectors actually are increasing their pace of growth. So 17 to 18%, an actual increase here, an inflection point, which when you map it out, supercharger connectors per station, when you look at overall number of units, on average, there are now 9.5 supercharger connectors per station, which is up from 9.4. And when you break out down the overall decimals, you can see that it is actually increasing. So it used to be stuck, towards that or stagnant at 9.1, 9.1, for a couple of years here. But now we're actually starting to increase that, which is another interesting point, because one other bull case, which not a lot of people are talking about, is, the supercharger network monopoly, where while there might be other EVs, they will start to license, and have deals with Tesla for using Tesla's overall supercharger network. And as EVs expand as a whole, that's going to be a whole new important revenue segment for Tesla. So, of course, important to keep track on the overall supercharger stations and connectors. I didn't chart it up, but we saw a decrease in the mobile fleet, which I thought was interesting. That's also one that has been consistently growing, similar to these, but an actual decrease quarter over quarter. But I think we covered, most segments. So what is my new revised fair intrinsic value for Tesla? So keep in mind, my valuation, I've now started to include Robotaxi. I don't include Optimus yet because it's not yet tangible enough. So anything that Optimus might perform, I kind of get for free if I can buy Tesla below my fair value. So prior to this earnings report, I think my fair value for Tesla was something like 360, 370, maybe 350, that range, towards 350. It is now, as of today, 26th of July, it is $265 per share. So it's a bit overvalued now. However, keep in mind, I do not give any value to Optimus. And I have revised down auto sales compared to my previous intrinsic valuation, which, when you map it up against, overall market share of the EV market, it is decreased by quite a few percentage points. I also revised down, energy storage growth. I was a lot more optimistic, but now, we're starting to create a downtrend. So I have revised down that a bit. And also the bigger part, which affects FSD, which, because my forecasting model is like 10 years out, FSD plays a huge part, especially towards those later years when FSD scales up. And what I use to determine how many vehicles will be available is I look at overall auto revenues divided by the average price per delivery. And since that has been going up, the FSD revenue is impacted negatively. So you can watch my previous Tesla videos for the valuation model approach. Unfortunately, since I launched my Substack, I do not share the model for free anymore, but all my valuation models are available on the Substack at research.typeofcapital.com. So if you go here and press intrinsic valuations, you can download them all. Also, keep an eye out. So I have this segment here called company coverage, where I post, a complete thesis for a company. So I've already published Palantir completely for free. This article, it is very long. If you're curious about Palantir, check that out. A complete thesis with all the risks, and it also includes the valuation model for Palantir. I'm going to be writing one for Tesla shortly, so that will be coming up soon. So keep an eye out on research.typeofcapital.com. I will be launching a bunch of more company coverage articles, which are very in-depth and detailed, a lot more detailed than this, quick review here. So thank you so much for watching, everyone. Research.typeofcapital.com, and I will see you guys tomorrow or in a few hours for Palantir Weekly. So thank you so much, everyone. Bye bye, and see you tomorrow.